Hello, everybody. Welcome to today's webinar. We've got a handful of people entering the webinar room as we speak, so we're going to let everybody get in and get situated, and we're going to get started here in just a minute. All right. Well, good afternoon, everybody, and welcome to today's webinar. My name is Jason DeBono. I'm Vice President of New View Trust Company, and I'm going to walk us through which is kind of a fun and certainly complex topic to talk about, and that is UBIT and UDFI. We've got about 30 minutes allotted for today's webinar, and that we may use all of that time. If you do have any questions, you certainly can ask those through the through your screen. Because of the number of attendees on today, we're not going to have any live questions in terms of being asked orally, but you can type your questions in, and those will pop up here on my screen, and I'll be able to get those read aloud for you. So welcome again. We'll go ahead and get started. I want to start. Excuse me. Let me make sure. I'm going to start with a disclosure, and this is a really important one for today's webinar, and one that probably is more important today than some of the other webinars that we teach. And that is to understand that New View Trust Company is a non-fiduciary trust company. We provide services to self-directed accounts. We are not attorneys, we are not CPAs, we are not financial advisors, and we don't in any way pretend to be, especially today as we go through and we talk about the complexities and tax liabilities potentially associated with certain investments inside your account. I want to make sure that everyone understands nothing that we're going to talk about today is in any way to be relied on as being tax advice, investment advice, or any sort of legal advice. So I want to start with what exactly is UBIT and UDFI, and really they're two separate items that fall under the same section of tax code. IRS publication 598 is ultimately what defines tax on unrelated business income of exempt organizations. That's a pretty fancy way to say it's a tax that applies to entities that are normally tax exempt. So I'll give you a couple of examples that hopefully will illustrate what that means. If you were to take a nonprofit, let's just say Goodwill, for example. If Goodwill decided to go out and start a restaurant, or inside one of their Goodwill locations, they started a restaurant, the IRS says the idea of generating income, for Goodwill is based on, providing clothing and other, items out to people to buy, and there's obviously a charitable component to that. But if you're simply going to go out and start a restaurant, we've got to find a way to tax you. And what they're saying is we're not going to tax you as a whole. We're simply going to carve out that income and we're going to tax you. So the idea behind UBIT and UDFI and really tax on unrelated or on exempt organizations has to do with taxation where you have income derived outside the normal course of your tax exempt status. So as we walk through that today, we're going to really talk about two different taxes. Some things we'll talk about that will be the same, meaning UBIT and UDFI have the same tax rate. They have the same ideology and same publication, but they differ in their application. So we'll talk in cases where they're different, and then we'll come back to where they're the same. UBIT standing for Unrelated Business Income Tax, and UDFI standing for Unrelated Debt Financed Income. So we're going to start with UBIT, commonly referred to as UBIT. We do find that a lot of times UBIT is commonly used even when discussing UDFI. And so a lot of times you'll hear people say that may be subject to UBIT, and in reality, it may actually be subject to UDFI, which is kind of the cousin to UBIT. But for general conversation, a lot of people will use UBIT as the overarching term to define this tax. Unrelated business income tax is income from trade or business regularly carried on. So if you step back and think about that, it's income for trade or business that's regularly carried on. So generally something that you did one time may not trigger that, but an activity that's carried on would be the case. It's unrelated to the exempt function. So this would be, as I mentioned earlier, that restaurant at a goodwill is really unrelated to the exempt function of the goodwill. And it's trade or business income. So you're selling goods or performing services. You'll see there's a little bullet there about the real estate gray area. When we talk about unrelated business income tax, it really is exactly that. It's business income tax. So I'm going to use a couple of examples on its application to help you to help illustrate when it is applicable and maybe in a scenario when it's not. The first thing from an IRA perspective, and we're only talking about UBIT's impact to retirement accounts. We're not talking about UBIT's impact to a nonprofit, even though we're illustrating its basic ideology. When we talk about UBIT and its premise inside an IRA, it generally applies when a pass-through entity, so LLC or limited partnership, right, has engaged in some sort of trade or business regularly carried on, i.e. selling goods or performing services, and the income is being distributed from that business back to a retirement account. So if you think about the way it works today, if you take your retirement account and you go out and you invest into, let's just say, shares of Apple. Apple is a C corporation. Apple generates business from selling goods and performing services. That business is taxed at the C Corp level, and when the returns are distributed back in the form of dividends or in the form of profits from sale, those are all of that income goes back into the IRA. The reason that UBIT would not apply in a scenario like that is because that income, or I'm sorry, that business, trade or business income was taxed at the C Corp level. So Apple paid the tax for the trade or business and then distributed back earnings after the tax. Therefore, the IRA received taxable earnings. Therefore, they're not going to be taxed again. But if Apple was set up as an LLC, a pass-through entity, meaning Apple did not pay tax at the entity level, and it generated all the same profits from the same types of goods and services that it offered, and it took that money and it sent it back to you as an IRA holder, the IRS says, your IRA is not exempt from paying the tax on that business activity. It's not saying that you're double taxing. It's not income taxed you as an individual. It's saying that your IRA, as a tax-exempt entity, has received income from trade or business that's not part of the exempt status of the IRA. Therefore, UBIT would be triggered on that income. Now, before you think that UBIT is a bad thing, remember that income came to you from Apple set up as an LLC pre-tax, meaning you would have gotten more money in that scenario than you would if Apple was a C corporation, paid tax, and then distributed the money. Now, whether it nets to more or less money, that's a calculation that you're going to want to take a look at individually. But understand that UBIT's primary premise is to apply to income from trade or business activity that wasn't taxed at the entity level you invested into. So if you're going to utilize your IRA to invest in corporations or other tax-paying entities that are engaged in trade or business, you're not going to be subject to UBIT. But if you're going to use your IRA to invest into pass-through entities that are engaged in trade or business activity, then you may be subject to UBIT on some or all of the income or profits derived from that investment. And again, don't let it scare you. Just understand you're paying it at the IRA level versus the entity paying it at the entity level. When I say the real estate gray area, we're going to talk a little bit about this, but generally real estate as a general rule is not considered to fall under UBIT. So if your IRA was to invest into an LLC that owned 2 pieces of rental property, unless that was considered a general business activity versus passive real estate income, you would not be subject to UBIT unless the case could be made that that was an operational business. And there are scenarios where that case can be made. So you need to make sure you understand if you're intending to use your IRA to invest into an entity, i.e. LLC or a limited partnership that's a pass-through, then you want to take a look at what the activities are inside that entity to determine if they can be under the exclusion as passive real estate investment, or if they're going to fall into that active business arena. And that is a gray area, and we at NewView are not the ones that will decipher that. We're happy to tell you what we've seen, but as a general rule, there is no clear-cut guidance by the IRS that says, if that LLC buys and sells 2 houses, it's passive. If it buys and sells 4, it's active. There is no line in the sand on that. So just be mindful of that if you're going to engage in those types of transactions from a real estate standpoint, where the line is in terms of what would potentially trigger UBIT and what may not. Keep in mind that we're only talking about the business activity. We are not talking about debt finance yet. So when we talk about real estate inside an entity, again, we're not talking about whether or not it's debt financed. We're talking about whether or not the activity of the entity is considered a trade or business, therefore subjecting the IRA to UBIT if the tax is not being paid on that business activity at the entity level. So there are some exclusions and deductions, and I know this is a pretty busy slide, and this is not meant to overwhelm you, but it's meant to kind of help illustrate. Now, UBIT can be a little bit complex because you've got a lot of moving parts in a business, but there are deductions that you can use to take against potential UBIT liabilities. So again, same example, I'm going to go invest $50,000 into an Apple computer-like investment that's set up as a pass-through. If the entity is paying tax, this is all a moot point. But if the entity is not paying tax and is deriving that trade or business income, then I need to be prepared and understand if and when UBIT would apply. So first thing is I can take deductions. So they're expenses that are primarily related to the business, can be expenses, depreciation, and similar items attributable solely to the conduct of the unrelated business activities potentially can be deductible. That may fall more into the nonprofit world, as well as net operating losses. So if my investment into that LLC lost money for 3 years, I can carry those losses forward against year 4, maybe where a gain was made, and I can either offset or potentially eliminate UBIT. Charitable contributions, again, probably more of the nonprofit side, but wanted to copy and paste some of the code. And then there's a specific deduction of $1,000 that you get as well. So what you're doing is saying, I received $4,000 of income from this investment this year. And then just like any sort of deductions, you want to figure out what's applicable to lower that $4,000 as far down as you can get it. Obviously, if you can get it to 0, you're not subject to UBIT. The lower the amount you can get it to, the less UBIT ultimately that the IRA will pay. Exclusions to unrelated business income. So royalties. So if you're investing into an investment that generates royalties, those are typically excluded. So your IRA could invest into an LLC. Even though it's a pass-through, that LLC could distribute $10,000 to you throughout the year, but it's only considered UBIT income if there's no exclusion. And if that is a royalty, it's excluded. If you make the same investment and it's distributing back rents of real property, right, then that income is also considered excluded from UBIT. You'll notice there is a note there about indebtedness, meaning you had leverage on the property. We're going to cover that in better detail under UDFI. But for the sake of discussion for UBIT, we're going to assume that there is no debt on the property, and that income from that rental income would be passive. Now, if you are going to invest into an entity that is renting or is generating rents of personal property, so they're renting out something like a boat or a car, making their money not off of real property but personal property, if that amount exceeds 10%, meaning more than 10% of the rental proceeds are from personal property, then it would not be excluded. Right? So it's really important to understand the exclusion only provides to rental of real property, not personal property. So if that entity is doing a combination of both, obviously it would need to do over 90% of its rental proceeds should come from real property, thus creating an exclusion of that income. So an example for that would be if you rented out a lake house. You own an IRA invested into an LLC, and the LLC rented out a lake house. And on that lake house, they had a boat. And the rental did not include the boat, but you could, for an additional fee, rent the boat. Both of those incomes would come back to the LLC. Both of those, all the rent from both the lake house as well as the boat would come back into the LLC. If at the end of the year, you were to take a look at the income and say 92% of the income came from the real property and 8% came from the boat, then you would fall under the full exclusion because less than 10% is from personal property. So you would be able to exclude 100% of that income as being rents of real property and be excluded from UBIT. If you were to rent that and if you were to do the same transaction and the income at the end of the year was 40% from the rental of the boat and 60% from the rental of the lake house, then you would need to take that 40% and carve it off, and it may be subject to UBIT. It would no longer be excluded, right? So just some things to be aware of. And then the gains and loss gains and losses from the sale of that real property as well. And understand what we're talking about right now is generalized. We're certainly not digging into the weeds about exactly what the dollar amount of a tax would be. So I'll continue to move on here. But if you do have any questions, please get those typed in, and I'll gladly get those read aloud and answered. So now we're going to talk about UDFI, and then we're going to kind of marry these two things, both UBIT and UDFI, together at the end. So the first thing is unrelated debt-financed income is different than unrelated business income tax. Unrelated business income tax has to do with investing into an active business-like entity that is passive, that's a pass-through, an LLC or an LP with a retirement account. UDFI is not entity-based, although it can be. UDFI has to do with your IRA's ownership, either direct or indirect through an entity, of real estate that's debt financed. It's very specific as to its application. UDFI applies to income from debt leveraged real estate. It applies to income in a pro rata share to the debt ratio. And we're going to talk a little bit about that in better detail. But to give you an idea of what that means, if my IRA owns a piece of real estate that is 50% bought cash and 50% bought with a mortgage, then for tax purposes, the IRS says my debt ratio is 50%. Therefore, following that very simple logic, 50% of my income or proceeds from sale may be subject to UDFI. So you're only subjecting the IRA to UDFI on the leveraged portion. And that's really important because if you put 60 or 70% out of the IRA and only borrow 30 or 40%, you're reducing the amount that may be subject to UDFI. And then trade or business income, right? Selling goods and performing services. We talked about that. And then most importantly, and this is a really important piece to understand, it only applies to IRAs. And there is an exemption inside 401ks, specifically solo 401k plans, that do not subject the account to acquisition debt UDFI. So what I mean by that is if I were to go out and buy a piece of real estate with my IRA account and I were to leverage 50%, I would be subjecting 50% of my income or profits to tax. If I were to make that same investment inside a 401k or a solo or individual 401k plan, and I made the same investment and it was the indebtedness was put on it when I bought it, I would not be subject to the tax. So for those of you on the webinar today or listening that are considering the idea of using your retirement account to buy a piece of real estate with leverage, I would strongly encourage you to take a look at the individual or solo 401k plan, which we do offer as a means, if you qualify, of avoiding that UDFI tax. And that can be a significant benefit to utilize that 401k plan, especially if you're planning to take on leverage inside that account. So how is it calculated? So when we talk about the calculation of UDFI, right, specifically UDFI, and we're going to talk about UBIT in a second, but when we talk about UDFI, the calculation is the average acquisition indebtedness divided by the average adjusted basis of the real estate multiplied by the gross income equals your UDFI. So to give you an example, and this is sourced directly from the irs.gov website, and they may want to update this because it looks like 1971 is the year that they're using in their example, but don't worry about the year, worry about the content. So I'm going to kind of read this and just talk through it. So an exempt trade association, so it really doesn't matter, let's call that an IRA, owns an office building which is debt finance property. The building in 1971, you can fast forward to 2019, produced $10,000 of gross rental income. That's our gross income number that you'll see in the formula above. The average adjusted basis of the building for 1971 is $100,000. That's the bottom number on the first part of our calculation. The average acquisition indebtedness with respect to the building is $50,000. That means the average amount of debt on that building for the year was $50,000. Accordingly, the debt basis percentage for 1971 is 50%. That would be $50,000 divided into the $100,000 that was our average adjusted basis. So if you take that 50% times our gross income of $10,000, the amount subject to UDFI is $5,000, 50% of the gross income, which is $10,000. So we're going to walk through that example a little bit further from a tax perspective. So now you can see I've plugged those numbers in. So we've taken the $50,000, which represents our average indebtedness for the year, and we've divided it into the $100,000 or by the $100,000 that represents our adjusted basis. That's where you're able to calculate in things like improvements or your depreciation and other things. So that calculation multiplied by the $10,000 of income is $5,000. So you could really do this pretty simply in your head. Now there's a little bit of calculation that goes into that $100,000 number, which is your basis. But that's pretty standard, and the IRS actually provides, and let me see here, if I go back, they do provide some pretty good detail, and there is a publication, I think it's 1101, but I'm speculating a tad. But if you were to Google calculating adjusted basis on real property, it'll give you the specs and parameters on how you get to that number. So when you take a number, and it really doesn't matter how you look at this. If you were to take a piece of real estate that generated $22,000 of income for the year, you would take your $22,000 and you would multiply it by your debt ratio, which would be the average debt divided by the average basis. So if that number was 70%, then it would be 70% of the $22,000 of income. And that spits out, in this example, the $5,000. That $5,000 represents the basis, or I'm sorry, the amount that you're going to calculate into the tax rate, and we're going to walk through that table. I do see that there's a question that's come in. I'm going to address this slide, and then I'm going to go ahead and pause for a second and get that question answered. So in this example, we've made $10,000. We've got $50,000 of average debt, and we've got $100,000 of basis. So the calculation tells us we have $5,000 of potential UBIT. If forget about any other exclusions, and there is a $1,000 deduction that factors in, but just to keep the math nice and simple, I went ahead and pulled the 2018 Trust and Estate Tax table. You take the $5,000, and if you see on the left-hand side of that, the left column, if the taxable as income is between $2,551 and $9,150, which is where $5,000 falls, then your tax is $255 plus 24% of the amount over $2,550. The amount over $2,550 is $2,450 times 24% is $843. And that's the $255 plus $588. So let me restate that because I may have confused that a bit. The $2,450 times 24% is $588. Added to the $255 equals $843 of tax liability. So you made $10,000 of income, and you paid a tax of $843 using very simple math. That number may even be a little bit lower with some additional offsetting items. So if you really do the math on that, your tax rate was 8%, right? 8.43%. So now when you start to look at it, that's not a very scary number. So we start thinking about this tax as being a lot scarier than it may be. Now, certainly it can creep up, and we're going to talk about some ways to maybe avoid that, because what we find in most cases is where the real tax bite is when you start to get into over $9,000 of income, of gross income, especially when you get above the $12,000. And a lot of times that's generally on the sale, right? That's where you start to see the major item. But even on the income from rents, we may see a $20,000 on a really good rental property. But if you go back and do the math, you can see that it's not the rate that you're paying. This was 24% of a tax rate that really worked out to become 8.5%. So a couple things to talk about, and then I'll get to the question. So the first example is, let's assume that this property was just $100,000. Let's assume the basis was exactly what I paid for it. I paid $100,000, and let's just assume I made the $10,000. Let's assume that was net. I know we're using this as a gross example for tax purposes, but just to drive from a rate of return standpoint. If I were to take that $100,000 and make $10,000, so I pay cash for it and make $10,000, my cash on cash return is 10%, $10,000 against a $100,000 investment. But in the power of leverage, if I take that same transaction and I only put $50,000 down, I borrow $50,000, I still make the same $10,000, right? However, right, I've got some debt service that's going to come out of that, so you need to factor that in. But my cash on cash return has now gone from $10,000 against 100 to $10,000 against 50. And if I calculate that, less the tax of 843, I still have $9,000 coming in against only $50,000 invested. I've now taken my cash on cash return up towards 18% versus 10% cash on cash if I were to buy it. So you can see, even net of tax, I'm increasing my ROI on this deal because I'm making the same amount of money on significantly less investment. So I'm going to sneak up here, and I apologize for getting so close to the camera to get to the Q&A. And the question is, are cash balance plans subject to UDFI? I would ask if you can simply give a little bit more when you say cash balance plan. I'm not familiar with that term. It sounds like it may be a form of qualified plan. But if you can give me a little more specifics on that plan as to what it is, I'll be happy to get that answered for you. So let's go back to the tax liability. So when we're talking about UDFI, it really can apply in two manners. It applies on your income, which is what we're talking about today, and it also, or I'm sorry, on this particular slide, and it also applies to dispositions, so proceeds from sale. So the calculation is the same. So if we sold this property for $100,000 and our gross income was $100,000, you would then do the math on the $100,000 to get your calculation. So it's pretty straightforward. I gave you guys the formula and the tax rate. You can play with this to get you as close as you'd like to what that number looks like. But it is important to understand that that is really where the largest impact from a tax perspective generally is on disposition, because it's going to be a bigger number pushing you into a higher tax rate. And obviously the combination of a larger number and a larger tax rate creates a higher tax liability. But one of the things that I want to talk about that's really critical, and it's actually the second bullet down. So if you're going to make this investment inside an IRA, UBIT cannot be, or I'm sorry, UDFI cannot be avoided if you're going to buy property with debt. It's just simply the way it works. It's the power of leverage comes with a cost. And generally we find through our clients that cost pales in comparison to the value of debt leverage. But that's a decision for each of you to make. What I want to talk you through is, now that you understand how that calculation roughly works, you can start plugging in numbers and comparing. If I bought this for 100 cash, what would I make? And if I bought it for 100, but put 50% down, what's my debt service? What's my gross, income going to be? And what's my ultimate tax liability? You can start to compare ROI. That's up to you guys to do. But two things I want to make you aware of from a UDFI standpoint. Number one, I mentioned this already. If you're going to buy a piece of real estate with debt inside a retirement account, I would strongly encourage you to look at qualifying or finding a way to qualify for a 401k plan to make that investment. It doesn't always work, right? So you may not be able to, but if you are able to, you can avoid that that UDFI for acquisition debt. It's a major, major benefit. But let's assume that you can't. For whatever reason, you're going to buy it in an IRA, and it still makes sense. One of the things that I've seen, and this is something that my dad's done inside his account, is buying real estate, utilizing debt, but paying off the debt 12 months and a day before disposition. So this will not help you on an annual UDFI. Your annual UDFI for income cannot be avoided unless you're using the 401k. But in an IRA, you're going to have to pay a little bit of tax as you generate income annually. But to avoid the biggest bite for UDFI, if you have the ability, you can pay the property off, retire the debt 12 months and a day before you sell it, and you will not be subject to UDFI on any of the profits from disposition. So if you were to take a piece of real estate, using the example we're already talking, $50,000 down on a $100,000 piece of real estate, you could carry that property for 10 years. And at the end of 10 years, you could pay that remaining balance off. Maybe it's only $30,000 or $35,000 of remaining debt. You can pay that off, wait a year and a day. You could sell it for $1 million, and that $1 million would not be calculated against UDFI because the debt was retired 12 months prior. So as these transactions tend to go on over time, paying the debt down reduces your UDFI on an annual basis. Paying it off within a 12-month window actually eliminates the UDFI. So remember, 12 months and a day. So on those properties that my dad owns, he took advantage of the power of leverage. He's had a little bit of UDFI along the way, which has not been a big deal. And 12 months and a day prior to him putting that on the market, he's going to pay the debt off from another IRA that's invested into other investments, so that indebtedness goes away. 12 months and a day later, that property can be put on the market for sale and no longer be subject to tax, which is really a cool strategy. So I'm going to pause there. I've got a couple questions that have come in. Let me get these opened up. So the cash balance plan was redefined as a pension plan, and the short answer to that is yes. If it does qualify as an ERISA plan, that exemption does apply. But I will tell you, you do need to confirm that through your pension plan administrator to be certain. And the reason is you want to make sure, based on the structure of the plan, I can tell you in general terms, the short answer is yes, but you do want to make sure. Now, what you are also going to need to do is ensure that that pension plan can own real estate. You cannot roll the money from the pension plan to an IRA, because once it's rolled out, you lose that exemption because it's now part of an IRA. So you're going to want to take a look and make sure that that can be held. Something worth noting is, if the pension plan is eligible to buy real estate, New View Trust Company can actually perform the record-keeping services on behalf of the pension plan. So we would not hold or provide admin at the pension level. We would simply hold and provide record keeping at the asset level for that particular piece of real estate. And that's something that we find we do quite a bit of. And a lot of pension plans will allow it, but their plan administrator and the custodians that they use simply don't do it. So if your plan does allow it, we can come in and provide that opportunity. All right, so this question, I'm going to read it out here. I have used my self-directed Roth IRA to invest in real estate LLC. The UBIT was $800, so less than the 1K deduction, but there was depreciation loss. Do you still need to file the 990T so you can claim the loss when in future you might have gain? So yes. So the real question being asked is, if you want to carry forward your losses, do you need to file if you want to carry forward anything against future gains, do you need to file? And my short understanding is yes. I'm not an expert on the 990T. That is a purely a tax document, and we simply don't file or review tax forms. And I can tell you in my experience here, I've just never come across the specifics, but of whether it has to be, but my understanding from communication with accountants that have dealt with that is yes, it's best to file even if you don't have the tax liability. It's best to file and made a declaration that the calculation has been done, and it also puts on record anything that may be carried forward for a later date. Are taxes on sale taxed at capital gains rates or trust rates? My understanding is everything is taxed at the tax rate, or I'm sorry, the trust rate, not the capital gains rate. Whether or not there's a long-term benefit, I don't know and can't speak to, but it is the trust rate that the IRA is being taxed at. So the proceeds from sale against disposition would be calculated into that same two-column chart that was on the preceding slide. And remember, if you do have questions, we're going to wrap up here in just a minute, but I'll gladly take those. When we talk about UBIT, UBIT is a number. It is a gross income number, and you will any entity that issues a K1, there's actually a line item on the K1 that defines the dollar amount of income that applies to UBIT. So that's done at the K1 level of the entity you've invested with. If it's a single member LLC that doesn't produce a K1, then you're going to want to have, and everything's a pass-through, then it would be that gross income number back to, that's distributed out to the IRA that would be plugged into that trust tax rate table. One of the things that does come up, and specifically for UBIT that we have seen, is we've actually seen blocker corporations that have been set up in between the entity, that pass-through LLC or limited partnership, and the IRA. And I'll illustrate that without going too deep into detail. But what we have seen people do is they've taken an LLC that is an operational business, so they've invested into an Apple-like company, and I use that simply for example. It could be a lawn care business, a restaurant, it really doesn't matter, but that has trader business income. That trader business income passes through the LLC into the corporation. The corporation then files a tax return and pays at the corporate tax rate, right? And we've seen a reduction in corporate tax rates. So they may pay a straight line amount against that income. I think it's 21%, give or take, as a corporate tax, and then the corporation, the C corporation, distributes the income back to the IRA. So the IRA invests into the C corp invests into the LLC. And what you do is you're then, instead of paying, if you've got $50,000 of income, instead of paying $50,000 of income at a rate that's as high as 37% in the trust rate, you then subject the income to the corporate tax rate of 21%, again, estimating a tad bit, and it can reduce that taxable amount. So it's not eliminating, but it's reducing it. So the common term that's used in the marketplace for that is a blocker corporation, is nothing more than a C corp that houses the IRA's investment and in turn makes the pass-through business investment out of the C corp. UBIT and UDFI, regardless of which one, once you have the tax and know what's due, is paid by the IRA. It is not a personal tax, it is not income tax, nor is it double taxation. Remember, it's only tax that applies because you've gone beyond the tax-exempt status of the account. So people say, don't ever buy real estate with leverage in an IRA because you're going to pay double tax. And it's absolutely untrue. You're simply paying tax because the IRA generated income with money that it didn't have to generate income off of. So using $50,000 from my IRA to buy a $200,000 piece of real estate, that's $150,000 of leverage that I didn't have in my IRA, yet I get the luxury of the income. So UBIT tax is simply a tax because the entity didn't pay it, therefore it passes through the IRA. It's not a double taxation, it's not income tax, it's simply a tax because it wasn't paid at the corporate level. So whether it's UBIT or UDFI, just understand that their application is fair, and the logic behind them is sound. And you got to make a decision when you have a chance to make an investment, which one's going to yield you better results. So I used the example of Apple earlier, and I'll take it a step further. It's really the net gain, right? If I can invest into Apple as a publicly traded security that's a C Corp, and I can invest and generate a 9% return for the year, then I want to compare that to if I can in turn, instead of investing into that, I can invest to a small computer manufacturer that's not public, that's set up as an LLC, and they're going to make a 25% return. And obviously I'm illustrating. And of that 25%, let's assume I pay 10% of that in tax. My net return is 15%. Well, what am I better off, making 15% on the private investment or 9% on the public investment? And if the numbers were turned, 15% in the public investment and only 9% after tax of the private investment, then I'd buy the public investment because the return is better, right? So just look at it from a net perspective. Don't let the tax scare you. Just understand that it's there. Form 990T is how these taxes are filed. And then you want to be aware of any state tax. There is no clear-cut definitive guidelines about how UDFI and UBIT are handled at the state level. A couple of states have made some documentation to support it, but nothing concrete. Most states do not. So a lot of people view it as only a federal tax, but you know, we're domiciled in Florida and South Dakota, where our trust company is, and so we can't speak to how it applies to any of these other states that and how it may be treated. And then there may be a consideration for estimated quarterly tax payments, and that's something that you want to talk to with your tax professional as well. So that's all the information that I have. I'm going to go ahead and get to this, the last slide here with our contact info. I've got, looks like another question has come in. And it says that UBIT, you mentioned UBIT has a 1K deduction. Does UDFI have the same 1K deduction? And the answer is yes. It is, if you go to the 990T, it's very close to the bottom. There's basically a $1,000 deduction from that number. So yes, it does apply. Both of these taxes end up on the 990T, and that's where that $1,000 is listed. So the only real difference between the two taxes is its application and calculation. Obviously, for UBIT, it applies to all the business income. For UDFI, it only applies to the calculated amount based on your adjusted, your average indebtedness or debt ratio divided by your average adjusted basis, and then that's obviously multiplied by your gross income. So I will pause for just a second. I don't see any other questions that have come through, but if you do want to ask a question, now would certainly be the time as we close out. You'll see on the screen there all of the contact info needed to reach any of you is there. I know we have a mix of both clients and prospective clients on the call, and I want to thank you guys for taking the time to join us. I do want to remind you that I am not a tax professional. I've been in this business for 14 years. I've seen a lot of transactions, but when you get down to the ultimate calculation of the tax and determining the amount due, that's something that we just simply don't participate in, nor do I have any experience. So I don't see any other questions coming along, so I want to thank you guys for taking the time to join us for our Wednesday webinar series. We do host these webinars every other Wednesday on a variety of topics, and we hope that you found today's session informative, and we appreciate your business for those of you that are clients, and we look forward to serving those of you that are not. Thanks, everybody, and take care.